Well, I think the headline is that we'll recoup these numbers in the month of October, and the Fed will continue to tighten rates in December. We'll see another rate hike in December. And in fact, we're set up for a fairly sharp reacceleration in wages in the October data, which comes out in early November. So all that's going to be sort of shifted into spillover, almost in a mudslide sense, into the month of October data, which will be right before the Fed meets again in December. So I don't think there's any question that this changes the Fed's course. Labor markets are still strong. The one little caveat that we've been watching that we'd like to see more improvement is long-term unemployed actually tick up this month, and the long-term unemployed, those people unable to sort of be re-engaged in labor force, that's something that we've seen is a long-time wound of the financial crisis, and we know that those workers, they've had an erosion in skills, and they are suffering from both mental and physical problems that the rest of the labor force is not seeing as much. This is making them harder to re-engage.
Very detailed headline from you, Diane. David, I want to get to you and ask you the same question as it pertains to stocks. What is the headline that we should glean from this latest report?
Well, I think the unemployment rate is, or the labor market is even tighter than the Fed thought it was going to be. Their estimate for the fourth quarter of 2018 is 3.7%. The number for September was 3.68%. So it's quite possible we'll average a 3.6 for the fourth quarter. So it's tighter than expected. I think Hurricane Florence took about 25,000 jobs out of the payroll number. We've also got those upward revisions. We've got a very strong employment number in the household survey. So I think it's a very strong report. I'm not seeing that much wage inflation still. I mean, it is remarkable that we've got a year-over-year wage growth of about 2.8% in an economy with year-over-year CPI inflation of about 2.7%. in the tightest labor market in 50 years. So I think we will get some follow through in wages, but wages are still very subdued given the tightness and the strength of this economy. So to me, it's not about inflation. It's about this is a strong report. It's going to keep the Fed on track to raise rates in December, in March, and in June.
David, does the way the yield curve is reacting, whether this week or today, and moving up in quite a pronounced fashion, alter the way the Fed is going to think about this data or not?
No, I think long rates were just too low, and real long rates were too low. I think the Fed's movement to redeeming or reducing its balance sheet by $50 billion per month, bigger budget deficits, I think that is pushing up long rates. But ultimately, I don't think the yield curve is going to tell us anything about recession or slowdown. I think really when the yield curve goes inverted, it means that people expect the Fed to ease. And I don't think there's anything right now which is pointing to a near-term ease by the Fed. So I expect to see a still upwardly sloping yield curve into the middle of next year. And I think the Fed keeps on tightening at least till they get to sort of, 2.75% to 3%, and they think they're pretty much at neutral.
Diane, average weekly earnings did rise by 3.4%. I think that matches the best level since August of 2007. Any takeaway there for whether we're going to see an acceleration from that level?
Well, I think we are set up in October on year-over-year wages to see some pretty strong gains. And I think David makes a good point, is we've just really not seen the average hourly earnings numbers pick up. We've seen other measures move up, but not there's still a shadow of what they once were. And that is something that still bothers the Fed, but will not stop the Fed from raising rates. I think it's also important to note the full-time employment and professional hires is really picking up relative to temporary hires. Those include jobs with benefits. That's a change from what we saw earlier in the cycle, and even a change from what we saw in the late 1990s. So we are seeing, even though wages aren't picking up as much as we'd like, we are seeing compensation pick up in some areas. One, because hours work are going to pick up, I think, next month by quite a bit. But two, we're also seeing those benefits finally come back in, which were stripped away from many employees during the crisis.
You know, David, Jeff Dunlap over at Double Line Capital was making the commentary that the 30-year yield, we focus mostly on the 2s, 10s, but the 30-year yield looks like it has broken out from a multi-year base at this point, and that was sort of the last man standing when it comes to points on that yield curve. How do you look at that? His point was essentially that now that we've broken through this multi-year base, that this means higher rates overall for the markets. This is going to pave the way for the rest of the yield curve to move up.
Yeah, I think it could mean somewhat higher rates. I mean, I think that the mystery really all along has been how can the dynamics of demand in the bond market keep long rates so low in an economy which is doing so well. But I think, that there's going to be further pressure on the bond market, because if you look at it on a not seasonally adjusted basis, November is the single strongest month in the year in terms of payroll employment. So as companies try to ramp up employment for the holiday season, it's going to be pretty tough to hire people, and we may see some strength in wages. We may see more complaints of not being able to find people, and that, that could put some further upward pressure on the bond market.